Yeah, we were just talking about this East Money, this internet brokerage that has basically now more valuable than the likes of Credit Suisse. You have a lot of mom and pop investors now shifting towards these managed funds to buy stocks. What does this tell you about the nature of this Chinese rally?
Well, I think in general, as a whole, the onshore China A-share markets is still in the middle of some kind of a bull market. Right now, it might be going through some kind of consolidation phase, but we do think that the longer-term trend, it is still on the uptrend. In particular, on the back of the very loose of the loose monetary conditions in China is still going to maintain. So that will continue to support the markets. And at the same time, you compare the valuations of the China A shares with other developed market indexes. In fact, the China A shares is not expensive. So on the backdrop of that, of a global liquidity-driven equity rally, I believe that the Chinese equity market is still on the uptrend. So people would want to buy the beneficiaries, and that includes the securities firms.
Right, and you're also one of the largest providers of ETFs in Hong Kong. What are you seeing in terms of flows right now? Is there a direct rotation out of U.S. tech into Asia tech?
Well, I probably won't say that is a rotation. I also see that the U.S. tech is still quite well supported. I would just say that there is just money buying both kinds of tech names.
Wilfred, I just got to get your views on whether you want to start to shift from large caps to small caps, or in fact, the reverse. We've seen small caps outperforming on the mainland. I'm talking, you look at the Chinex, it's up 43% year to date versus about 7.5% for the Shanghai Composite. Does that trend continue, do you think, or is it time to look back to the safe havens of large caps here on the mainland?
Okay. Yes, the small mid-cap names have performed very well this year, and they are somewhat kind of also in the consolidation phase right now. But looking into next year, for example, with the uncertainty of the US election removed, and probably with the COVID situation more clear all around the world, and with the economic recovery around the world, not just China, but globally speaking, again, is more on a more clear path. Probably looking into next year, the large caps in the Asia markets would would perform instead of the small mid-cap names.
I know that you think there's still opportunity, or there is a buying opportunity now in the growth stocks in this part of the world. What are you adding?
Okay, well, the thing is that the growth names, they've done very well, and then there has been a correction, maybe starting from a few weeks back. If you look at especially we use the Nasdaq as a thermometer of that is happening. However, we do think that over the longer term, these kind of growth names, especially the technology-related names, the names that are related to digital disruption, the disruptive industry, and disruptive names, this trend is continuing. So over the long term, they will continue to perform. So right now, they might be consolidated, that it could be a correction, but the longer term trend has not changed. And if you compare that with the more kind of old economy or value type of names, some people with a few weeks back, they wanted to switch from the growth names to the value names. However, we believe that this is just purely more for a shorter term. We will recommend it is more for a shorter term technical trade. Because a lot of the value names, they are very much related to the broad economy. And even though the global economy is slowly recovering, it's going to take quite a bit of time to go back where it was. So this recovery could be quite slow if you look into the next year. So the value names might not present an opportunity that is as good as the growth names.